So, please, you you published a very interesting study, research on joint audit and audit quality, and we would like to hear the results of your research, and are very happy that you agreed to come to France to make such a presentation. The floor is yours.
Thank you. Thank you so very much. No, the pleasure is all mine. Thank you for the invitation. So I'm here as the academic. So I'm afraid there might be more citations and references in there than you might like. We can skip through those very quickly. I teach corporate governance. I research and investigate corporate governance and audit, the role of audit within corporate governance. And one of the perspectives of my work is on the quality of judgment and decision making and factors that impact on that. Okay, so we're looking at joint audit. Closer. Thank you. So we're looking at joint audit and audit quality, the contribution that joint audit might or might not make on that. And I'm looking at this from a perspective of something called bias and heuristics. That comes from psychology and behavioral economics. That looks at how human beings, and even if we want to dispute that, auditors are still human beings, form their own judgments when it comes to their work. Okay, can you hear me? In my classrooms, I'm usually booming loud enough so 250 students can hear me. Okay, let's go. Very briefly, I think we can agree that the quality of audit has been questioned in the past, is still being questioned, whether audit is performed to a standard that is adequate as expected by stakeholders and society. There are rafts of scandals where auditing or accounting irregularities were at least pointed at, and the auditors typically, after a corporate governance scandal, is also being at least pointed at, saying where was the auditor, what was the auditor doing, what is the board of directors doing, of course, as directly involved. Frequently, issues of competence and independence and professional skepticism are raised in post-fact investigations. Audit, as we have heard, is providing an assurance, is important for capital markets. It also has a social role, is part of a social contract. We allow audit firms to perform and do these audits for remuneration, but we do also have expectations as to the quality of the work that is performed as part of that contract. Now, audit quality is something we aspire to, but we are not absolutely sure what it means, how to define it, or how to measure it. There are wide disagreements in the public discussion, and wide disagreements also within academia of how we actually measure audit quality, and that leads to the issues of judging, say, joint audit or any tool and any procedure that is used in audit to enhance audit quality, how we measure these in terms of providing or adding to audit quality. Looking at empirical investigations, empirical research, the opinions indeed are widely dispersed, quite opposite sometimes, ambiguous results as to whether joint audit contributes to audit quality. Joint audits perform better in certain aspects, whether joint audits cost more. So let's leave it at that. There are disagreements in investigations, also in empirical investigations, and there are ambiguous results. investigations or summaries of investigations that look at all of the research, or the vast majority of the research that has been conducted on joint audit, come to the opinion that we don't really know how to measure that. We don't really agree on how audit quality is measured or what contribution joint audit might make. Slight changes in the modeling approaches, slight changes in the assumptions underlying the models can change the results quite significantly. The most recent summary of joint audit research that we came across was emailed to us by Patrick just recently, and that comes to very similar conclusions. The empirical investigations don't really guide us towards support or otherwise of any particular tool in audit. Now my question was, well, if we don't really know how to measure that, and if past investigations, the last 40 years of investigations really leave us with less than a firm opinion or of support or otherwise, then maybe we're asking the wrong questions in that research. So my question was, what should be the aim and the objective of implementing a joint audit regime? There was a panel earlier this morning, two gentlemen here who were sitting on audit committees and in companies, and they had a very firm opinion on joint audit, on the benefits of joint audit. They saw how the challenge between auditors and the challenge to management can be beneficial. On that note, just briefly, if I may, it's not on the slides. If a company that is being audited is, let's say, sticking to the rules, does not engage in excessive optimism or earnings management, then the need for audit is actually lesser if the company is behaving accordingly, if management is behaving according to expectations, then the audit might contribute, but it doesn't, is not as critical. But if there is an issue with the company, either with write-downs or issues with projections, issues with any kind of judgments where management's judgment can differ from that of auditors, then the quality of audit matters much more and the work of the auditor. Okay, so my questions were, what should joint audit actually aim at? What is its purpose? And specifically can joint audit mitigate the impact of bias and heuristics? Now, the bias and heuristics literature, if you're not familiar with that, looks at how individuals form judgments. How do we interpret information? What kind of information do we look at? How do we take that information to either confirm or contradict a belief that we might have on something? That came out of work by Tversky and Kahneman. Tversky is no longer with us. Kahneman got the Nobel Prize for his work. On looking at the situation where people make judgments under uncertainty. So we don't know 100%. And of course, audit is at the crossroad of uncertainties. Often in accounting and auditing judgments, we base our interpretations on assumptions, estimates, projections, ambiguity and unpredictability, because we have to make projections into the future. We also take managerial assertions and have to interpret those, whether they are reasonable or not. And what Kahneman and Tversky looked at was simply that individuals, far from being perfectly rational decision makers, and there's a whole raft of literature that looks at that, comes from economics, was very popular in the 80s and 90s and early 2000s until the banking crisis, and it went out of favor a little bit. They said, well, we're not really perfectly rational decision makers, but we use something called heuristics, quick mental shortcuts. There's a huge literature on that. They are efficient, they are quick, they are hardwired into our brains, so it comes from our evolutionary history, if you like, but at times they can lead us horribly astray, and they can do so in a very systematic way. We can make errors, and we don't necessarily notice those errors. We think that we're making good judgments when we really are not. Funny enough, the FRC, which this morning said they're not terribly in support of joint audit, they themselves recognize the impact of heuristics on the quality of decision making when they talk about the work of directors on the board. This is equally applicable to the work of auditors, because we're making judgments under uncertainty as auditors. In many times we just don't know, we make estimates. Okay, so we can sometimes be led astray by these heuristics, and we can make severe and systematic and long-running errors. It affects our information search, it affects the way we interpret information to either support or distract to an opinion. And in very short, on the last line of the slide, poor judgment formation. So that's relying on quick and short mental shortcuts can lead to errors, can bias our judgment, can make poor decision making, and then we go back to number one, and this reinforces ourselves. Okay, I don't have enough time to go into detail on this. It has been applied to the work of single auditor. In the 80s and 90s, that was quite a large stream of research being conducted on how auditors in a single audit team engagement perform their judgment. And are auditors, highly qualified and highly experienced individuals up to senior partner level, are they subject to heuristics? And yes, lo and behold, they were found to be, as anybody else, subject to biases and making use of heuristics that can affect the quality of their judgments, which flows into the quality of the opinion at the end of the day. Okay, so they follow all of these. We don't need to go into detail. All of these typical ways of our judgment formation, which can lead to mistakes, and auditors were simply found to, be as human as the next person, and also make these errors without noticing these. The problem with biases and heuristics is the subconscious. Okay, so any decision we make is affected by these. Even if we don't think we are, even if we think I'm a straight person, I'm a very, very, very rational, and I take all information and weigh it equally. On the whole, no, we don't really do that. So every decision you can assume, and you should assume, is affected by biases, various cognitive factors. There are ways and means of mitigating against these, i.e. working against these, but these have to be built into your decision-making processes. Now, again, that is also subject. Biases also work on groups, and of course an audit team is a group. You have a senior auditor, you have a partner, you have an audit team, you have an office manager working together, so they form a group, a team. And unfortunately, within groups and teams, you get another set of biases that affect that. So we can get something called groupthink, where suddenly a herd goes towards one direction, even if it's bad for the herd, and it gets reinforced. And even if they're individual concerns, they might go along with that for various reasons. Okay, we leave it at that. Now, very briefly, auditor judgment is affected by heuristics and biases. And often this may lead to a lack of professional skepticism, where they simply assume that managerial assertions can be accepted at the base fact, or that managerial assertions that were accepted last year are still valid this year, and we signed off on the audit last year without any problems. What should be wrong? It's the same management. Okay. The lack of professional skepticism has been highlighted and raised again and again and again. In every review of poor audits, lack of professional skepticism comes out. The FRC is aware of biases and heuristics and how this may skew our decision making and make it poorer. They've put this in an official guidance. It's the guidance on risks on board effectiveness at the very last paragraph here. This is applied to board directors, but it can equally apply to audit and audit teams. At least there's corollaries for that. Some of the wording in that document is mine. I consulted with ICSA when they did the 2011 version of that lovely document. So, professional skepticism for you, I'm sure you are aware of what professional skepticism is, but it's on a spectrum. It can be a very neutral view where you say this, let's say the financial statements may or may not be containing material misstatements, or you can go to an extreme where you say, let's assume that there's something wrong with it, and let's look for information to convince us otherwise. Forensic auditors go into an audit after the fact, after something has happened, with a presumptive doubt. Actually, they know that something went wrong, and they look specifically for the things that had gone wrong during the audit or within the financial statements. And they have no difficulties in finding that. I find that quite interesting. When a forensic auditing team comes in, give it a few weeks, they will have figured out what went wrong in a seemingly complex fraud or management behavior that wasn't acceptable, when the incumbent auditor found that very difficult to find over years and years and years and years of their engagement. Look at Carillion or Wirecard or Enron or WorldCom, or this morning, and I brought back memories, earlier scandals from the 80s in the UK. When you look at Polypec and the Maxwell scandals, the incumbent auditor being surprised by the things that were revealed. A forensic auditor will have figured that out in 2 weeks. I find that interesting. Okay, right. Just two figures and percentages in here, so not too much. And I'm almost coming to the end of what I wanted to say. Is the FRC in its audit inspection cycle, out of 130 audits inspected, found that nearly 40% were poor and required significant improvements. That's out of 130 audits. The Dutch Authority for the Financial Markets, the AFM, deemed 19 out of 32, that's nearly 60% of inadequate, whatever the definition of inadequate, not good enough. If my students were producing that kind of quality work, they wouldn't be students very longer. If I produced that kind of work, I would be out of a job in 2 weeks. They'd fire me. Boom. Anyway, in sum, not enough professional judgment, lack of professional skepticism, insufficient challenge to managerial assertions, or not collecting sufficient or adequate evidence to support the opinion come up again and again and again in these reviews. Okay. Let's skip to joint audit and skepticism. When I started to write some of my research, I looked at whether a key contribution of joint audit could be to audit quality could be from enhanced professional skepticism, more professional judgment, and increasing challenge to managerial assertions. I.e. standing up to management saying, no, you can't do this, or no, this treatment is not adequate, or can't be done, we can't sign it. Okay. There's some work cited below for you for later if you have time or the interest, how some of the characteristics of joint audit might contribute to these better characteristics of a good audit. Some of these points in italics were mentioned this morning. There's a critical mutual review of the audit plan and the procedures and the work of the other team. That is critical to a joint audit. If you don't do that, you don't have a joint audit. You have a shared audit, or you have some kind of split audit, but it's not a joint audit as per the definitions and the French standard and the expectations of what a joint audit should do. You should critically challenge assumptions, assertions and justifications of the other team, on top of that of management. So you do a cross review on top of doing that, of course, against managerial assertions. It should, and it does in many instances, if performed properly, encourage a skeptical framework. Skeptical framework that comes from the behavioral issues. When you're looking for a problem, you're more likely to find it than if you're not looking for it. If you're looking simply for confirmation of your prior opinion, then you are disregarding or ignoring information that might stare you in the face. You just don't see it, or you dismiss it, or you misinterpret it, or you give it a different weighting. If you're looking for something that's wrong, you see information in a different light, and you're more likely to spot certain things. Hence, we come down to a forensic audit mindset. At least a little bit of that. I'm not saying you should go into every audit assuming that management are crooks. Okay, even though this might have helped in the audits of Enron and Wirecard, of course, but the vast majority of management, let's assume, are decent folks. Let's assume that. But what if they're not? How can you tell that they're not? That's the issue, because I'm sure most managers, at the top firms that got into this repute were very friendly and very nice and civilized. But the problem is you can trust, and you should trust, but it shouldn't be blind trust when you're doing an audit. Okay, so this is almost the last slide. So we often you hear proponents of joint audits saying all sorts of lovely things. And I'm not here to say one way or the other. I won't pin you, I'm not telling you. No, I can't tell you. I think it's good for you. But you have two pairs of eyes. You have more diverse teams and more diverse experience. There is a critical mutual review. The emphasis is on critical. Mutual review at the end of it is just to say, did we tick all the boxes? Yeah, what good does that do? None whatsoever. Switching tasks so that one audit team then speaks with the other audit team and looks at the areas the other partner did. You also get that retention of client knowledge if you have staggered rotation that was mentioned this morning. So if you have, let's say, a 3-year rule, whatever the rule is, so that they don't have a cliff edge where both auditors just leave and two new come in and you lose all of that experience over time. Empirical research does support some of that. The report that I wrote is available here. If you look at the third paragraph, it's put on SSRN as a research depository, and that goes into some length, as you can imagine, to explain why those positive things might work through a behavioral cognitive perspective. So that looks at specifically at how individuals and groups and human beings make judgments and good judgments, what can affect that, and how might that result and yield into those positive characteristics of a joint audit if it's done properly. Joint audit can go wrong, of course. It's not a magic bullet. It's not guaranteed, but you can see that it has a better chance, if performed with certain objectives in mind, to mitigate against certain biases, hence to lead to better decision making. At least that's an assertion I'm making. Over 60 or 70 pages, however long the document is. This is a bit of I got carried away. I do apologize for that. Okay, and I'm looking at investigating that further. So I'm talking at the moment to audit partners and regulators, and goodness knows anybody who wants to talk to me. So if you had any chance, pop me an email. I'd love to talk to you for half an hour on Teams about your opinion on joint audit, what works, what does not work so much, how you think it might or might not. I doubt I would be speaking to the German regulator who was here earlier, who was really opposed to it, but it might be an interesting conversation. Maybe he missed something. I know Babington personally. We met at conferences, and he's not completely against joint audit. I wouldn't think so, but he follows a certain agenda, I'm sure. But the German fellow surprised me. Good Lord. I come from Germany myself, so I can get away with saying that. Okay, thank you very much for your patience.
Thank you very much, Oliver. Are there questions to you? Yes, Mr. de Fabiani.
No.
Do you make a difference between skepticism
Wait for the
and
microphone.
challenge?
And
And my second point is, don't you think that if we benchmark every data, every practice, it would help?
okay, skepticism and challenge. Well, they work together. I think. If you're skeptical, well, if you're not skeptical, you won't challenge. But if you have professional and you apply in a systematic way professional skepticism, so where you don't take managerial assertions or interpretations as a given and simply move on, then you might be likely to challenge. Challenge to management. Joint audit also works best if you challenge the assumptions and the procedures of the other team, saying, did the other team actually do a good job? Did the judgment and the opinion they base on their work, is that justified? Your second question was, sorry.
Benchmark every data, every practice.
I presume it would depend on what benchmark you apply.
Yeah, but I can tell you, I was in the oil and gas industry at the time of Enron, and when we benchmarked, Enron was so far away that there was something wrong. But
Okay. I think I'm getting what you mean then with benchmarking. That reminds me also a little bit on with regard to the WorldCom scandal. WorldCom was the largest telecommunications company in the United States at the time. Telecommunications, internet, fibers, they were in everything. There were about 4 or 5 competitors on the market in the United States who all at the end of the dot-com boom, when all the fiber had been laid in the ground and there was nothing else to do and the boom was basically over, they were all suffering problems and falls in revenues or falls in growth. WorldCom said it was not affected by any of that, and it showed figures that were fantastic. Now, to me, not being an auditor per se, and not maybe being an expert of the telecommunications industry by any means, that would raise flags. Then I would say, how come those guys can, when Enron could not explain actually how it makes its business, and had 3,500 special purpose vehicles into which it offloaded its liabilities. A child in the street, I asked my daughter about it, she was at the time 8, and she said, Dad, isn't that something wrong there? She doesn't know what an SPC was, of course not. Okay, but she says, if you have so many things where you're putting all of your assets and your liabilities just to move them off your books, she got that. She said, how do you know the company is actually making money? Or whether the money they claim they're making is real. Okay, and that's where perhaps that is where the benchmarking comes in. So you should, I think that is also called common sense. You step back sometimes and say, let's not look so much at the figures and the standards, but is this actually a story that makes sense when a company spins a story of how successful they are and how wonderful they operate and how much revenue and profits are going to grow? Can that actually be? I mean, maybe it can be. I mean, Tesla finally makes money, and maybe they're proving everybody wrong, and you see Teslas all over the place. But for many years, they were huge in debt, but very little in delivery. Okay, are there any other questions? Oh, of course.
Maybe 2 quick questions. The first one is independent reviews. You do not talk at all about what independent reviews within an audit firm can bring compared to joint audit. My first question. The second question is about accounting principles. Because, you may have a problem with the accounts, but just follow the accounting principles. And the complexity of accounting principles, may make some decisions not that clear, whether you go on one side or not other side. And that's a topic you do not address either.
Maybe not so much on the slides. Okay. Having an independent review depends on who does the reviewing. How independent is the reviewer? If it's within the same firm, You might say, well, yes, we have Chinese walls, we have separation. Those people over there on the review team were not involved in the audit themselves. But how confident are you that a separation within a firm works when colleague has to review another colleague? How critical would they be? And if there's any result or impact on future revenues or the ability to obtain a renewal of the auditing contract, how likely are we going to be highly critical of our own fellow company members? Or whether in a review during the process rather than at the end of the audit on the quality of our procedures that lead us to the audit opinion works better. So an earlier review, I would think, is better than an end of a process review. Your second question? Yes, of course. The accounting principles themselves are, of course, and flexibility, that was mentioned. I mean, accounting standards are flexible. We're not looking at simply counting beans. That would be easy enough if we just looked at inventory and said there's 10 here and there's 20 there, or end of story. As long as we can assess the value, of course, of inventory properly. But accounting standards can be flexibly applied. You would have a company's management who would love to be as flexible as possible. That's called earnings management in a sense. It can be earnings management. The problem, of course, is where the flexibility goes beyond what is acceptable, and who makes the decision of what is acceptable flexibility, and where does that then go into fraud or lying or unacceptable application of standards. So that's where you might have two different diverse cultures or sets of auditors with different skills and different backgrounds and different involvements in the original opinion or individual assessment of certain accounts, where they can maybe able to step back and say, yeah, maybe there is something that is stretching the imagination a bit too much. Let's revisit that and let's review and let's discuss perhaps with management and the audit committee, because management may be the problem. Let's have a talk with the audit committee and try to convince them that maybe it's worth to have another look or to change our mind a little bit. Okay.
If I may, on this, there was something that caught my eyes in the paper that you shared with me, dated August this year, which was the fact that you based on your work, one of the possible improvements that you see with joint audit would be that the type of joint auditors differ, meaning having a small firm working with a large firm, because of the differences potential differences that you see in the personal background of the people, and therefore the different approaches that they may have to the same topics.
Of course, you're quite right to mention that. I mean, there is empirical research that says Big Four and Big Four teams work best or provide better results. Now, I have an issue with the methodologies that are being used to measure these kind of things. I'm not saying these investigations are wrong, but I'm saying they're not as firm or as reliable as we might hope. There is a literature on diversity in group decision making and diversity in teams, and diversity of the individuals that are tasked to make a decision or form judgments or approve certain, let's say, a management plan, a senior executive management plan, and diversity tends to be better. Different diversity, of course, not just gender or background or color of skin, but also, if you like, culture and ways and means of doing things and different perspectives. Because if we're all from one background and have a similar mindset, we might not see a particular issue with a proposal or a project or an interpretation of a standard as it may be, whereas people who come from a different direction or have a different methodology or simply a different let's say, less averse to being critical, even if it's to individuals who are, literally in power of the organization, that can, under certain circumstances, raise issues or point to problems which would normally be ignored. So teaming a Big Four with a non-Big Four, a challenger firm, what have you, may, under certain circumstances, and that's the devil in detail. Okay, not all teams work best in all circumstances, but if there is a critical problem with a company's accounts, or if they're just being too optimistic, or if they're trying to minimize their exposure to risk, so if there's a critical issue somewhere, a more diverse team with different experiences and different approaches might pick this up and might be able to challenge when a single audit team or a joint team consisting of two teams with a similar background might not pick this up. So that was the long story.
Thank you very much, Oliver. And this was very interesting, and thank you for accepting to come here and have an in-person meeting with us and with the participants to this event.
Oh, thank you.
Something that we really appreciate nowadays.
Oh, so did I. The idea of having one more video conference scared me and didn't appeal. So when I saw a little window of opportunity of actually cutting across the channel, I took it and grabbed it. I think it helps to have in-person conversations rather than video or only video. And after 18 months of this, everybody gets a bit tired. So thank you very much for having me. It's a pleasure.
It was our pleasure.
It's all mine. Thank you.
So we will continue with the last item on the agenda, which is dealing with the input of the representative of the financial markets regulator and the prudential regulator in France. So I welcome Marie Sayer and Emmanuel Rocher to the scene. So Marie is the executive director for corporate accounting at the Autorité des marchés financiers, AMF, the French markets regulator. She has been there for some time now, and before that had spent 7 years with an audit firm as a senior manager before coming to AMF. She is also a representative of the chair of AMF at the board of H3C. So we have occasions to discuss regular meetings. And Emmanuel Rocher joined the Banque de France in 1999, where he was first head of staff to the chair, the governor of the Banque de France. And since April of this year, he has been appointed director of international affairs at Acpr, the banking and insurance supervisor. And he is also the representative of Acpr at the board of H3C. So what we would like to know is the type of relationship, type of interactions that you as regulators have with auditors, and whether there are specificities related to joint audit that you can highlight to the audience today. Maybe ladies first, and I'll give you the floor, Marie.
Okay, thank you very much. So, hello everybody, I'm very glad to be here and to participate to this meeting today. We are the Financial Market Authority, so we work mainly with issuers, but we consider that the relation with the auditors and the regulator of the auditors is key to strengthen the market. So that's really something which is important for us. We mainly work with issuers having 2 auditors because, as you know, in France, joint audit is required when you have consolidated accounts, and on a regulated market, you have consolidated accounts in case you do have subsidiaries. So mostly all of the issuer, we sort of follow work with 2 auditors. So maybe first I will just elaborate a bit on the relation we have between the market regulators, so as IMF, and the auditors according to the regulation in France. So first, there is no professional secrecy between the auditors and the IMF. So basically, as the market authority, we can ask for all documents we would like, all information from the auditors, and they do have to give it to us. We can have discussion with the auditor, with the issuer, but we can also ask to have bilateral discussions, and that's something they should agree on. And in some cases, the auditors are obliged to inform us in advance on where they are. So the example are, for example, in case of resignation, they should explain us. And when, according to their work, they come to some specific conclusion, for example, there are irregularities, they just tackle, or the issuer do have some issue regarding going concern, so there are some judgment on the conclusion on going concern, or they think they will issue a potential qualified audit opinion, refusal of certification, or express reservation. In all these cases, they should inform us in advance, and basically what we do is that we do have contact with them just to understand and see afterwards if we need to discuss with the issuer also, just to follow the different case which are important for us. So on a day-to-day basis, the way we work is that, as you may imagine, we review the financial information of an issuer. So we do have a work program, and we also review the prospectus. So on all these elements, we do review the accounts. And we do include the auditors in all the process of the review of the accounts. So basically, when we ask questions to the issuer, we also copied the auditors, and we ask specifically the issuers to check the answer he gives to us with the auditors, which explain for us, yes, that the auditors are really important in the sort of environment for us. And afterwards, we always include, of course, as you may imagine, the 2 auditors in the process, so not only one of them. And afterwards, if needed, as I said, we can ask specific questions. There is one thing which is a bit specific in France, which is named the sort of pre-clearance process, which is basically not done in all European countries and in the world. So basically, it offers the possibility to the issuer to ask us for our conclusion on a specific technical issue before he closes his account. So basically, come with a topic and ask us if we do agree or disagree, and that before closing the account and informing the audit committee. So for us, it's quite important. And we believe it's really important to have this possibility because in that case, the issuer, the auditors, and the regulator has to agree before the accounts are approved on an accounting treatment. And as you may imagine, it's a lot more easier just to decide before than afterwards as regulator, just to come back and say, okay, there's something we do not understand. And we also consider that it's sort of a lot more timely. So it's something we really appreciate this process. So maybe now if we come to the way we see the audit quality and why the joint audit is important, we really have the impression that because there is 2 auditors, there are more challenges on the issuer analysis. On the example I just gave you regarding the pre-clearance process, I mean, often when an issuer came is because his auditors do advise him to come, and in most cases is because they do not have the same feeling on the judgments that the issuer might say, and one of the 2 might consider is a bit pushy, and maybe the other one a bit less, and so that's why they just come and said, okay, maybe it's important also to have your view as regulator on what you think on that. So we really have the impression that thanks to this sort of joint audit, it gives more opportunity for us to have this discussion with with the issuer and have more challenges on technical issues. I think even more broadly speaking, and not on this pre-clearance process, the issuer, we think, is more challenged by these auditors, because as there's sort of review of the file and both auditors participate to the meeting with the management, with the audit committee and all this sort of thing. I mean, all the key issues are known by the two auditors, and as it was a lot more said by Dr. Marnet, I think it really gives the opportunity to have more challenges and more sort of step back on what makes sense. And I think it's also even more important when we are talking about IFRS, where judgment is key and which are not sort of rule-based but judgment-based standards, and judgment, as you may imagine, might be different. We also consider that it strengthens the independence of the auditor, and independence, as you know, is really important, because on our market we have more audit firms with sort of large or medium size than in other countries, so it gives less weight to the big four and sort of gives the opportunity to have more audit firm and more, which is more important in terms of rotation on when you have a tender offer, because there are more possibilities. So I think it's important to have this possibility. And the fact also that you have two auditors, as it was said, facilitates the transition when the auditor change, because you might change one of the two auditors, which means that you still have sort of history, because otherwise, if you're talking about a very huge company with a lot of issue, it's quite, I think, difficult to have all the auditors changing at the same time. So basically, in a nutshell, what we can say is that we really think the system, and with this joint audit, strengthens the quality of the audit, which for key is us to have a strength in the financial market. And we think that's even more important when transactions are more and more complex, and where we sort of IFRS, which is judgment-based words. So I think that's it for today.
Thank you, Marie. Very efficient as usual. Emmanuel, please.
Okay, thank you, Patrick. I will try to do my best after Marie, but I just wanted to thank the H3C for inviting Acpr to take part in this event and to give us the opportunity to present our views on the joint audit. So I will now talk about the joint audit in the banking and insurance sectors, which the Acpr is responsible for, and try to draw some lessons learned. So first, as a first remark, I would like to insist on the fact that auditors have a key role to play in building confidence in financial reporting. Audit quality aims at improving the integrity and compliance of financial information provided by the financial institutions. As such, it contributes to the proper information of users, the protection of clients, which is very essential, naturally, and last but not least, to the effectiveness of financial and prudential supervision. So I will elaborate a little bit on that a bit afterwards. So it therefore meets the objectives of financial security and stability. Auditors play an essential role in strengthening confidence and in published financial information, and in ensuring the proper functioning of financial markets. Confidence in financial reporting contributes to the integrity and stability of financial markets, and in some way to the work of the financial banking and insurance supervisors. So as you know, joint audit has been deeply rooted in France. Its introduction in 1966. It has always been presented by the legislators in France as a means to reinforce transparency and financial soundness, as well as reducing the risk of fraud within the largest companies. So it imposes a joint responsibility on each of the auditors, and what is absolutely key for us is that it comprises an independent review. Professor Marnet just spoke about this, but this independent review is actually a key element likely to limit the risk of conflict of interest. And from our experience, this dual review principle is also important in the event, naturally, of difficulties that have to be overcome, and can give comfort to the joint auditors when they question management positions. I would also like to highlight the importance of having effective and adequate interactions between the auditors and the supervisors. These interactions are absolutely essential for the sake of financial stability. This is why we have specific guidance to provide an effective dialogue between the auditors as a whole and the competent authorities in charge of the supervision of the financial sectors. As a result, the interaction between the auditors and ACPR take place within a very formalized framework that is defined both at the international level, because where we have specific guidelines coming from the Basel Committee for Banking Supervision, but also from the IAIS concerning the insurance supervision. But also at the European levels, where we have also to apply specific guidelines from the EBA and EIOPA authorities, and at the national level, naturally. At the national level, for instance, the ACPR has drafted a guide for relations between the auditors and the banking and the institutions. And this guide has been drafted first in 2014 with the help of the body which is representing the industry of auditors in France, which is the CNCC. While all these guidelines naturally do not specifically address the challenges and opportunities of joint audit, they remind us that there's an effective interaction between the external auditor and the supervisors allows for a better mutual understanding of the respective roles and responsibilities, and encourage a regular exchange of information when it's needed. And let's now have a closer look at the interactions between the auditors and ACPR in practice. So as I said, from our experience, joint audit allows for a better understanding and communication with the supervisor. On the banking side in particular, we have in Europe this specific single supervisory mechanism, and within the SSM, there are regular discussions and exchanges between auditors and the joint supervisory teams in charge of the supervision of one specific group. So for the significant institutions that are directly supervised by the SSM. So these discussions take place once a year, and they involve the two auditors in charge of the auditing the significant banking institutions. From our point of view, the interaction with the two auditors allows for a more accurate appreciation of the risk profile of the institution and a richer dialogue on the year-end subjects for attention or on complex issues like these mentioned by Marie previously, such as the credit losses, the estimates, the accounting estimates, and several complex issues. And this is also a key moment to have a look and discuss the prospect for the next half-year statement. Which is important to know is that the discussion with the SSM and the auditors are the subject of an interview with the two auditors at the same time. We also found that in group audit, which is what is very interesting, is to know that at least generally the most significant subsidiaries in groups are audited by one of the group auditors and another auditor, which is a key element to provide the College of Auditors of the group with a global view and an adequate visibility on the global operation of the group. And to our understanding, the joint audit have proved to be reliable and efficient in the banking and insurance sectors, demonstrating a complementarity and allowing for a well-balanced distribution of roles between the two auditors, in particular in delivering the messages to the management of the groups. So to conclude, just wanted to insist on the fact that from our own experience as a French supervisor, we consider the joint audit to be reliable and plays a key role as a safeguard, as an additional safeguard for the financial supervisor in charge of the banking and insurance sectors. Thank you so much.
Thank you very much to Emmanuel and Marie. Are there questions from the audience? Professor Schatt.
Small auditor was not guilty. So this was not expected in a joint audit setting. What is your point of view about that? Was the judge mistaken, or do you share this opinion?
I'm not sure I can comment on that. First, I think I'm very glad to know that with Emmanuel, we agree as both regulators that it's important and we're able to have joint audit. And regarding question, I think it's difficult to comment on a specific case, so I can't tell you exactly why it was decided. I think it was quite a long time ago. I was not at IMF at that time, so I I will take the opportunity of that just to say I can't comment, and maybe it will be different today. I mean, don't know.
If I may, I won't be able to comment on the decision from the judge, but one interesting point in the Marionneau case is that the fraud, because it was a fraud in the beginning, was discovered because there were two auditors and they exchanged their controls within the group. So one auditor, when he started to look at the way revenue was recorded, identified a problem that had not been identified by the other auditor. So it shows that nothing is perfect. There was a fraud and it hasn't been identified in the beginning, but thanks to joint audit and to the rotation of the work that is, the areas of work that is done by each joint auditor, it was in the end identified. If I may, thank you very much for the views that you shared. I would like to share a personal comments on this aspect, because I've been a regulator in markets for some time, 14 years. What is obvious is that what the French experience shows is that we've been trying to improve the system over time. When you look back in the beginning, there was this compulsory joint audit, but no guidance on how to share the work between the two auditors. And at some point, the market regulator, it was the predecessor body to the AMF, the Commission des Opérations de Bourse, started to say, hey, we might have a problem there. We need to have something that is balanced between the two. And Professor Marne's paper was also very interesting in underlying that the problem with Denmark was that at the end, because they had no such requirement to have a balanced audit between the two joint auditors, one was doing the job and the other one was just checking the box. And that's not joint audit. And that's the reason probably it didn't bring the quality that was expected by the market, by the clients themselves, etc. And so, to begin with, the market regulator started producing guidance, inviting joint audits to be more balanced. Then H3C was created. H3C also took decisions in this regard. And so now we have guidance that is very clear for auditors in France on the balance that has to be reached between the two auditors. What this experience also shows is that there are things that are in the regulatory framework, like the things that Marie mentioned, which are if an auditor wants to resign and it's a listed company that is audited, then he has to come to the AMF. If there's a going concern issue, he also has the duty to inform the AMF, and they need to inform because there are potential consequences on the market, obviously, but also with the quality of the work done by the entity, which might result in a qualified audit opinion from the joint auditors. This is something that is due to the potential impact on the market, but it has also evolved into the perceived need by the market regulator to identify problems that may occur within listed entities that are put forward by auditors and will need further investigation and further thinking to see how to best deal with this information, in most cases informing the market, but also it evolved into discussions about the way IFRSs are to be applied, because as was mentioned earlier, there is a lot of judgment involved in some questions dealing with the application of IFRSs. And I don't know what is the situation right now. Marie certainly knows better than I do, but in the past, we had a number of discussions when new standards were coming into application, and there were many questions from the firms, from their clients. Sometimes the firms having disagreement between them, and sometimes disagreement with their clients. And I think the fact that it is not written in the law or in the regulation is not a problem. What matters is that the ecosystem evolved in a way that it allows a better quality in the end of the result that is published. If there are no further questions or comments, then I would like to thank you all.